Not like Tony's. How's everybody doing? Good, good, good. So I'm going to bring Tony up in a minute, but how many people in here got or have ever heard of PPP? Okay, everybody. How many got PPP? Everybody? Okay. So then you know PPP was a loan, right? And it was generally forgiven or, grant or forgivable loan if you used it for business expenses and that kind of thing. ERC has been around as long as PPP, but nobody knows what it is. Who in here has heard of ERC? Okay, who's gotten ERC? Okay, two people, right? So the whole room essentially has gotten PPP, but nobody except for two people have gotten ERC. There's a lot of reasons for that. The main reasons are that people either don't know it exists, or the people that do know that it exists generally have the wrong guidance. They've gotten bad advice, either from their CPA, their bookkeeper, their payroll company, their CFO, their attorney, their friends, their family. It's just a very misunderstood component of the same CARES Act. Totally different than PPP. It's not a loan. You never have to earmark it for business. You don't have to use it for business. It's literally a credit you get in the form of a check. So I'll bring Tony up. Tony is a mentor of mine, business partner, a friend. This guy owns multiple 7, 8, and 9-figure businesses. He's the COO of this company, and there's not a single person on the planet, I'm convinced, that knows more about ERC than Tony. So Tony Swantek, the COO of Jorns and Associates, guys.
All right. Can you guys hear me okay? I want to thank Pat for the kind introduction. I've known Pat for probably going on a decade now, and it seems to be any time we can lock arms together, it's always fruitful for everybody involved. So he's somebody that has definitely mentored me as well. I've learned a lot, especially in the marketing space and the online marketing space from him. I'm a little more old school, kind of a lot of face-to-face, knee-to-knee type scenarios. And the ERC for me, guys, it was something I found out about through my CPA. And I know a few different companies. One of them is kind of like Uber Eats or DoorDash, if you guys ever use delivery. It's called delivery.com now, but we were an Inc. 500 company and delivering in about 300 cities in the United States within our first 3 years. First 5 years we were Inc. 500, and Justin Jorns, who I've known since kindergarten actually, is our CPA for that firm. And then I have another company called Elite Payment Partners that does credit card processing. And we process about $4 to $5 billion a year in transactions. And so he's our CPA for that company as well. And so he contacted me almost a year ago and was just talking to me about ERC. And he'd been helping clients file for it through his firm through basically from March of 20. That's when the program started. And there were some companies that weren't allowed to do PPP loans, companies in the CBD space or anything like that. The federal government wouldn't let them apply. So they could do ERC though. And so he'd help these companies. He was very knowledgeable about it. And he educated me on it. And my thought process, honestly, was as a value add for my existing client base. We merged with Delivery.com back in 2018, and are still the largest franchisee in the world for Delivery.com. We have tens of thousands of restaurants we do deliveries for. And so we have great relationships with those restaurants. And then with our credit card processing, we have thousands of clients we do credit card processing for. And as I learned more about ERC, I just thought, you know what? None of my restaurants that I've talked to, as I learned about it, none of them knew about it, or a lot of them thought they didn't qualify. And a lot of the retail stores that we did their credit card processing didn't take advantage of ERC. And so it was something that we became pretty passionate about, and I got with Justin and I just said, listen, why don't we create a branch from your firm that all we do is focus on ERC? Because we can do RD credits, we can do regular tax, we can do all that kind of stuff, but I said this is something that there's a window of opportunity for businesses, and I don't know what everybody's philosophy is in here. I'm kind of a serial entrepreneur, and my thought is this. If the government's giving business owners money, most government programs, from what I've seen over the years, somehow the money ends up back in the DC Beltway. There's billions of dollars that go out, and somehow it ends up back in DC. This is one of those few programs, along with PPP loans, in my opinion, where the money goes where it's supposed to go, to the business owners. And I know that as business owners, we can do a lot more for our families, for our employees, for our communities with these funds than if we leave it in Uncle Sam's hands for the most part. And so I want to go over some of the basics of the Employee Retention Tax Credit Program. As Pat said, it was introduced back in March of 20, the CARES Act. Back then, I think the reason a lot of people didn't take advantage of ERC is when the law was written at this time, you were not allowed to do both programs. It was one or the other. And PPP, and you guys might not be familiar with exactly all the intricacies behind it, but I'm sure your bankers were all over you to take advantage of that loan. And even some of your not bankers, like people were just calling you up going, you need to take PPP. Now, if you're not sure why, I can tell you why. The SBA paid a $2,500 commission for every loan that you wrote. So they got paid. Then if you're a bank and you can write a loan to a business and you know the government's going to pay it off, it's a really good loan to have on your books. It's really safe money. So PPP was easy. And to get it forgiven was pretty simple, right? Just use 60% on payroll, or you could use it all on payroll. But you could use up to 40% on approved operating expenses, which there was a lot of operational expenses if you dug in that were approved. And so pretty easy path to that money. ERC is not an easy path to the money. So back then in 20 of March, it's like you can do one or the other. Why even know about a hard road if there's an easy road that'll get you there and you can get it done, and you can't even take the hard road if you choose the easy road. And so it kind of went under the radar, but then in December of 20, something called the Consolidated Appropriations Act passed. Part of that act included what's called the Tax Relief Act. That's 2,700 pages of legislation. Most of you as business owners, and I know myself as a business owner, I wasn't going to read 2,700 pages of legislation. Now I have now because I got into that business. But initially for my delivery company and for my credit card processing company, my real estate, I wasn't going to read 2,700 pages. The senators and representatives don't read 2,700 pages. They got it the night before the vote, and then they voted on it the next day. So we know they didn't read it, right? So that went under the radar. There's hundreds of pages of guidance that was released by the IRS. So it's like, okay, what that did, though, is it said now if you did a PPP loan and got forgiveness, you're now allowed to do ERC as well. But nobody was taking advantage of it. Even to this day, not many people have taken advantage of it. The IRS management believes about 75 to 80% of small and medium-sized businesses should be able to qualify for at least some portion of ERC. As of 2 weeks ago, through the practitioners line, we talk with the IRS quite a bit because we have a lot of clients. Less than 3% of actual companies that they believe will be able to take advantage of this program, less than 3% have moved forward with a filing. And unfortunately, at the end of the day, no matter how great we are at educating businesses, there will be billions of dollars that are left on the table and not claimed for this program. And it is unfortunate, but we're doing as good as we can. The program's worth up to $26,000 per employee. It's $5,000 per employee in 2020. Up to $21,000 in 2021, and it's based on the wages paid. Technically, it's a credit against the employer's portion of Social Security for all quarters other than quarters 3 and potentially quarter 4 if you're what's called a recovery startup, a newer business that started after February 15th of 2020. If it's the 3rd and 4th quarter, it's against the Medicare portion of the employer's taxes. The great thing about this program is it's called a full refund. And for us, I know what a refund is, like if I go to a store and get a refund. Full refund, when the government talks about it in the IRS tax code, it's a term of art. It's a legal term. And what that means is if you qualified, let's say you had, 100 employees and you end up getting 10,000 employee in ERC and you get $1 million. But your employer's Social Security tax and Medicare tax was only $300,000 over that time period. They send you a check for the full $1 million. That's what full refund is. Now, the legislators built it that way. It's extremely important to know why that's a full refund. It's huge money. That's why somebody like Tommy, gets a 1.8 million PPP, but he qualifies for 7 million in ERC. Almost all of our clients will see a bigger number on the ERC side. Not all of them, but the majority do see a bigger number on ERC. It is paid via check. It literally comes, if you qualify by basically filing what's called an amended 941X. It's a quarterly payroll tax return, your 941s. We amend those. We claim the ERC on lines 18 and 26. You basically, tell you, hey, here's how much you qualify for. Then we make sure you qualify. We have a qualification report that kind of goes through why you qualify so that the IRS is asking, we know. But at the end of the day, you're getting checks from the Treasury. And if you qualify for 6 quarters, you'll get 6 separate checks. It's kind of random as well. So you don't get an IRS agent that's assigned to your company. They assign agents to each filing. So we've had clients that'll get a check from quarter 2 of 21 and then they'll get a quarter 3 of 20 check, and usually once the first check hits, it's a few weeks, and you'll start to see the checks come in, and I'll go through that a little bit more in depth. But there are a lot of misconceptions, as Tommy said, about ERC. A lot of business owners don't feel like they qualify because maybe their revenue increased. Maybe it didn't decrease, maybe they stayed about the same. But we've had clients whose revenue absolutely skyrocketed, and they still qualified. Because that's not something that disqualifies you, is by doing better. Maybe you didn't experience any shutdown. Maybe you received PPP loans, which again, we've kind of talked about how the law changed in December of 20 with the Tax Relief Act. And they can factor into the process, but they certainly don't disqualify you. And the qualification piece, I'm not going to go through each of these line items, but I'll share with you just some of the clients that we've had that qualified, that I was surprised on a couple of them, to be honest. And I tell people, we don't make the rules, we play by them. We have over 200 on staff with just the ERC portion of Jorns & Associates. So it's literally a dedicated team of CPAs, tax attorneys, compliance specialists. We have onboarding specialists, Microsoft Excel certified professionals. We've got teams basically that take someone through point A to point Z all the way through the process. So you can literally lean on us to do pretty much all the heavy lifting. Now, with qualification, there's 3 ways to qualify. They kind of break it into 2, but there's really 3, because the second way is kind of 2 parts. The first way is what's called a significant decline in gross receipts. And it is what it sounds like. It means you took a hit in revenue. And it could be pretty major. You needed a 50% decline in revenue from 2020 versus your 2019 numbers. And it's quarter versus quarter. Most of our clients did not experience that type of hit. But if you did, you can qualify for ERC. 2019 is always your base year, pre-COVID. That's kind of the year they look at. How were you doing before this pandemic started? And that's really the spirit of this legislation, is they want to know, listen, what was your day-to-day operations like in 2019, 2018, 2017? Now here comes this pandemic in 20. How did your business change? How were you affected? You might have still been essential, you might have still stayed open, but what are the things that you did that were different, that you had to do that were different? And so we look at your, obviously, gross receipts. In 21, if you had a 20% decline versus the same quarter in 2019, that could qualify you for ERC. But if you didn't hit that, unfortunately, a lot of business owners and even CPA firms, that's where they stop. Because if you dig in deeper, it's a lot more work. And the average CPA firm, we have 5 CPA firms that we're filing their ERC on their behalf. We have more than 10 CPA firms that refer business clients to us. We've worked together with a company, RSM, who some of you guys might be familiar with. That's one of the 5 largest accounting firms on the planet. And one of their clients, it's funny but not funny, we both did their qualification report. Some of our qualification reports, depending on your businesses, depending on how many states you spread, they can be over 500 pages long. Now, we'll have you review your report, but fortunately for you, we create like a 7-page narrative for you guys to review that kind of breaks out everything, so you don't have to read 528 pages of qualifications, but we have it on hand if the IRS ever asks and says, hey, we want to look into why do these people qualify. So first way is significant decline in gross receipts. Second way is a full shutdown. That is what it sounds like. It's pretty black and white. A CPA firm, they would look at that and go, yeah, I was a restaurant, I was a bar owner, and the mayor said bars and restaurants are closed from this date to this date. Well, that's a full shutdown. Most of our clients didn't experience that either. So the third way to qualify is why we have 500-plus page qualification reports sometimes, and it's called a partial shutdown. And there's a lot to it. There's hundreds of pages of guidance that discuss what it is to be partially shut down. It could be direct. A direct partial shutdown could be something like you are a construction business, you deal with trade shows constantly, you like to go to trade shows, you get a lot of business from trade shows. Well, in 2020, guess what there wasn't many of, if any? Trade shows. Almost all 50 states had a restriction on large group gatherings. So if there's a state, local, or federal restriction on large group gatherings and you developed a lot of business from trade shows and you're not allowed to go to them, that could be what we'd call a direct partial shutdown. It changed the way you did business. You're still essential, you're still able to operate and do your work, but how you do your work has had to change because that business development piece, you're not allowed to do anymore. And you're not punished for pivoting and figuring out another way to do it. So we had a company, Popeyes, there's 12, a gentleman owns 12 franchises, And they were up during COVID, all the way through. Quarter versus quarter, every single quarter was increased. And so their CPAs didn't think they would qualify, and they got us on the phone with their CPA team. They asked us some questions. We went through guidance with them. After about a 15-minute call, we got off. The owner called us back probably 15 minutes later, and he had spoken with his CPAs. And he just said, he goes, yeah, I talked to Kurt and Tim, and they said to go with you guys. I said, that's great. You know, it's great to hear. And he goes, I got to be honest. He goes, I asked them, why wouldn't you guys just file for me? And Kurt said, you know, because this guy owns multiple locations, he's like, you're probably looking at $5 to $10 million here. And he goes, I got to be honest with you, Bill. He goes, if I was your physician and you came to me and needed brain surgery and I was just your family doctor, I'd maybe give you a pill for the headache, but I'm going to have to refer you to a neurosurgeon. He goes, this tax code, he's like, if you make mistakes in this and I got you denied or didn't do things the right way and cost you millions of dollars, he goes, I don't want to take that on. He's like, that's all this team does. They literally, he said, Jorns, this is what they focus on. They have hundreds of staff that are literally looking through the guidance. They know it inside and out. He's like, you need to use them. And so they ended up moving forward with us, and we qualified them on that partial shutdown. See, they were open. Their state never shut them down as far as restaurants were concerned, but the reason their revenue was up was their delivery went through the roof. Their drive-through went through the roof, their takeouts went through the roof, but what hurt really bad was their in-lobby dining. And a lot of their city restrictions and state restrictions had social distancing, and I'm sure you guys remember walking into some restaurants and seeing like the caution tape, and like you'd have a booth and then a booth that was out of order, like, hey, you caution it off. So you're open, right? You've got 20 tables in there, but you can only seat 10 because of some of the state, local, or federal restrictions. That's a partial shutdown, and they were able to qualify. An indirect partial shutdown would be something like supply chain. Maybe you're open, you're operating, but your supplier is having issues, and their mayor did something or their governor did something that the ports were closed off for a while and no shipping was coming in and out, and now you can't get those raw materials or those goods from your supplier, and that's in turn affected your business. Now there's different check boxes we need to check off. The IRS asked, was there more than a nominal effect to a more than nominal portion of your business? Was that nominal effect to a nominal portion of your business linked to a state, local, or federal restriction for you or maybe your supplier? And we answer all those questions. Our team will dig in, and the bottom line is we'll figure out, do you qualify for the program? And about 3 to 4% of our client base, unfortunately, we kick it back. It's usually going to be virtual e-commerce type companies that don't deal face-to-face with anybody. They were already set up work remotely, so they didn't have to worry about, closing offices down or getting face-to-face with clients because they never did those things. So if we go through and a client doesn't qualify, we kind of give them the bad news and tell them they don't qualify, and that happens. But for about 96, 97% of our client base, we just go, you know what? Here's the guidance. Here's where you fall inside of it. Here's the report showing it. You sent us the data to build this report. Make sure that the revenue numbers are accurate. If it still matches up the data you sent us, then we're probably going to want to move forward and file this. And so we'll dig into the qualification. That's definitely the most in-depth process. The good news for you guys, there's a questionnaire you'll fill out that probably takes 15 to 20 minutes. As a business owner, there's a revenue sheet that'll take about 15 to 20 minutes. Probably not for you. Maybe you'll have your CPA do it or your payroll department, send us all the documents that we need. But the bottom line is our qualifications team will dig in and see if you qualify, how much you qualify for, and we'll send you a report to go through so you can look at everything, go, yeah, I understand this, I see why we qualify, and then our calculation team will tell you exactly to the penny what you qualify for. Scope of engagement is pretty simple. You'll provide us with the documents that the IRS requires us to have to file on your behalf. Usually you'll just connect this to your CPA, your bookkeeper, controller, your payroll department. We're getting 941s from you. We're getting your revenue numbers. If you got P&Ls, we'll take them. PPP loans, if you did get them, which a lot of you did, we'll want to see the forgiveness application. It'll show us your covered period. It'll show us, basically how much you were forgiven. Did you use any on operating expenses, things along those lines. Once we get all those documents, our team will start putting everything together in the file so we can run calculations and we can run the qualifications report. Our qualification report will be loosely based on the questionnaire. That's kind of the starting point to see where you were affected. The questions it's going to ask is basically, did you deal with any changes in your business, travel, suppliers issues, things along those lines. So our team will know where to dig deeper for you. Once you get us all your payroll reports, PPP loan forgiveness, we'll get anything if you used FICRA wages or anything like that for sick leave and got reimbursed for it. We'll find that out and we'll calculate the wages. We do have proprietary software. There's a lot of companies that are popping up that deal in ERC. We've helped over 3,200 clients apply for just over $2 billion in ERC in just the last 12 months alone. There's a couple other firms that are pretty solid. If you're using them, I know there's 2 people that have already done ERC. If you're using those firms, I would tell you your qualification reports are going to be strong. They're going to be really strong. There's probably 15 firms out there that if you use them, I would be a little nervous. I would say, let me see their qualification report. Do they offer audit assistance? Do they have E&O insurance? And I would just cover yourself before moving forward with a filing like that. And we've cleaned up a few filings and helped our clients make sure that they had, because it's not really a gray area. The IRS tells you what you need to have on point, basically in file for your qualification. And unfortunately, there's a lot of companies out there that are kind of popping up that are taking shortcuts. And there's definitely areas in life where you can take a shortcut, like maybe you know how to get to Camelback quicker, from one place to the other. But when you're dealing with the IRS, that's not the time to take shortcuts. So we don't, and it's just like we do everything by the book, cross the T's, dot the I's, make sure you're doing things the right way. And like I said, there's only a few firms out there that really have the resources and the hours to put in to make sure people are doing this the right way. Once we get everything calculated, we'll also look at your 941s. We'll make sure everything matches up with the payrolls you sent us, and then we'll file what's called a 941X, and we'll claim the ERC. We do not guarantee any specific refund amount until we actually run through your payroll data. I will tell you this, and again, don't quote me. We've helped 3,200 clients. The average client, their average employee, is worth about $21,000 if they qualify through the program. I look at it and go, even if, for my companies, I was like, even if it's $10,000 per employee, that's awesome. And the ideal is going to be, for us, 10 to 500 employees. We do go a little lower. For some groups, we'll go down to 5. For nonprofits, charities, churches, stuff like that, we go we'll do whatever pretty much. If they got 1 employee, we'll do it for them. But for most businesses, our target market is going to be 10 to 500. The rules change when you get over 500. You can still qualify, but if you do have 500 employees or you have multiple companies that aggregate to more than 500 employees, if you reach out to us, we can definitely talk with you and see if there are some potential employees that you have that could qualify. If you're 500 or less, you can qualify for every single employee's wage potentially. And so it's a big difference. We do guarantee our calculations are accurate. We guarantee our filings with the IRS as a paid preparer are compliant with program rules and regulations. And we do provide long-term audit support and carry E&O insurance of up to $1 million per client. There is a look-back period. There is what's called substantive consideration from the IRS on this. So it's not like a regular tax return. They're going to look a little deeper into this. Your audit ratio on a regular tax return is around 1%, maybe a little lower than 1%. The information, we hire away from the IRS about every 2 months. We bring folks that were internal over there to our team. And we know a couple things. One, audit ratio will be double or triple, so 2 to 3%. Still low, but definitely more audits than a regular tax return. We know a point of emphasis will be what's called aggregation. Some of you guys might have multiple businesses. We have clients that we've been able to do because we've looked at org charts, and one client we did had 52 entities, owned a bunch of restaurants, a bunch of franchises, but the way the ownership was built in there, it was like, all right, these 30 are what's called aggregated, meaning the IRS is going to look at them like one big company for that employee count. The employee count is 2019 only. So if somebody had, 400 employees in 2019 and 1,000 employees in 2020, that'd still be fine as far as the employee count. But if you've got 10 entities and all of them and you own 100% of all of them, or you and your wife own 100%, or you and your husband own 100%, then the IRS will aggregate it. And if you have 2,000 employees and you go, well, you know what? I'm just going to file all 10 of them separate, like they're their own business, the IRS will know that. They're going to look into that. That is definitely a point of emphasis. They're going to try and find companies that have thousands of employees that are trying to take advantage of this, because honestly, this legislation is built for small and medium-sized businesses, not large. And when you get over that 500, the IRS looks at you like a large employer. So bottom line, we'll help you guide through that legislation and all that guidance. Our fee structure, we really wanted to create a risk-free opportunity for people to see if they can take advantage of this program or not. So we charge a 20% contingency fee, and then we have a fully refundable deposit of $2,600 due upon signing. If for whatever reason you fell into one of those 3 to 4% of our client base where we just aren't confident that you actually meet the guidelines for qualification, we immediately refund the $2,600. I can't give your team back the 1 to 2 hours that they spend getting us the data. That's lost. But our team, on some of those files, we've spent 50 to 100 man hours and woman hours on them, and we just kick back the refund. It is what it is. But if you're one of those 96 or 97%ers that do qualify, and we get the qualification report, get the calculations, and we move forward, we'll invoice you for the 20%. That's not due until you actually receive your checks from the Treasury. So when you get your check from the Treasury, we invoice you. We say, hey, 20% is due minus the $2,600. We'll credit that towards your invoice on the back end. And then when you get that money, it's pretty much not earmarked. So, it doesn't have to be used on payroll like PPP. It doesn't have to be used on operating expenses. It's used at the discretion of the business and the owner. It's free and clear. It is what's called a reduction in payroll expense. We've got guidance we send to your CPA, and we've never really, there's a few CPAs we've had to talk to, but most of them, when they read through the guidance, it's pretty simple. So there could be some tax ramifications for you on it. It's not taxed as income. It's a reduction in payroll expense. I'll give you a quick example. So if you had $1 million in payroll and you had $100,000 in ERC for 2021, let's say, you have to amend your 2021 taxes and you say, instead of writing off $1 million in payroll, I have to go back and only write off $900,000. Because I got $100,000 in ERC, I basically write that out of my payroll expenses. I have to subtract it. Now, some of you, depending on how you did net, how you ended up financially at the end of the year, that might have tax ramifications, it might not. But we can work with your CPAs and help you with that. Bottom line, you're going to come out net way positive at the end of the day, and the money is not earmarked. You can use it however you want. We let our software perform calculations to eliminate human error. On average, head-to-head with the other two major providers who are really good at this, we average about 10 to 20% more in ERC due to our proprietary software. Some of the smaller providers will go 50, 100, 300, 500% more in ERC due to our calculations. I won't get too in-depth into software stuff, but the rules, when they changed the legislation in December, it basically said if you did a PPP loan and got forgiveness, you can now also apply for ERC. What the law also said is you're not allowed to use the same wages for both programs. So if you used a wage from an employee to help you get PPP loan forgiveness, that wage is off the books for ERC calculations. And that has ramifications. So what almost all companies do is they figure out what's called an exhaust date. They go, okay, let's see when your PPP loan was used up, and then from the next day forward, we'll grab wages and calculate for ERC. And listen, there's nothing wrong with that. It's not illegal to do that. That's in the guidance. You're allowed to do that. But the guidance says you can maximize your PPP loans and your ERC wage calculations. And what that means is you can technically, instead of figuring out that exhaust date quickly, you can actually elongate it through it. Let's say you had a 24-week PPP loan. Mathematically, you would want to use as much of that as possible because you're allowed to what we call maximize wages, meaning in the ERC, the max wage that's available is $10,000 for calculation. So if you paid me $100,000 in 2020, the max wage for the entire year from March 13th of 2020, that's when we can start grabbing wages, all the way through December 31st of 2020 for that year. If you paid me $100,000, the IRS says, no you didn't. Not according to ERC, we're going to lower it to $10,000. And you get a 50% multiplier times my wage. So you get $5,000 for me. If I was part-time for you in 2020 and you only paid me $2,000, they'd take a 50% multiplier and they'd say, all right, you get $1,000 for this employee. I might not even be working with you anymore. It doesn't matter. It only matters, was that wage paid to me, a W-2 wage, not a 1099 wage, a W-2 wage from March 13th of 2020 through December 31st of 2020 if we're looking at that year. 21's a little different. It's better for us as business owners. 2021, the max wage is still $10,000, but it starts over each quarter. So let's say you paid me 25 grand in quarter one, it caps it down to 10, and the multiplier is 70% in 21 instead of the 50%. So now you get 70% of that $10,000 max, which is 7 grand. Then next quarter, let's say you paid me another 25, you get another 7 grand. The next quarter you paid me another 25, you get another 7 grand. The fourth quarter used to be part of the program. After that Tax Relief Act passed, it included quarter 4 of 21. The infrastructure bill that signed in November of 21 removed the fourth quarter from the program. There's a bill right now, and you should, if you're business owners and you're going to take advantage of ERC, I tell business owners, I Google it daily, but you should Google, it's called the ERC Reinstatement Act. Yesterday I Googled it. On May 11th, 2 more representatives co-sponsored the bill. I don't know when it'll come to vote, but if it passes, which if it comes to vote it should pass, it'll add the fourth quarter back into this program. So the only thing that changes the ERC program is the law. PPP loan had a set amount of funds, and it was like, when it's gone, it's gone. That's how they set it up. Here, this program is a tax credit program. There's no set amount of funds. For this program to change, the Congress, literally the Senate and the reps have to sign through a bill, then the president has to sign off on it, or if he vetoes it, the Congress has to override that veto. But it takes a law of the land to maneuver this program one way or the other. The only laws that are out there right now, legislation, is actually looking to increase the money into this program because so few businesses have taken advantage of it, which is unfortunate, but it's fortunate that they've noticed that and they're trying to put some more money on the table for business owners that weren't taking advantage of it so far. So that's how this basically can change. It's a time limit. When you amend a 941 payroll tax filing, you've got up to 3 years to amend those filings. So if no laws change, you basically can file 2020 all the way through April 15th of 2024 will be the last postmark date for the 2020 filings. For 21's filings, April 15th of 2025 will be the last day we can mail things out. Now, I wouldn't sit around too long and wait, but the bottom line is that time frame could change. They could add more money to the program. The legislators can do a lot of things, and we keep an eye on it pretty much on a daily basis, our team does. The next steps, if you did say, hey, this sounds really good, I'd like to move forward, we can send out an engagement letter. It basically spells out the fees, it spells out the scope of engagement, what kind of documents we need from your team. I always tell people it's probably 2 to 3 hours of work for your team to get us everything we need in the order we need it in. Our team, it's about a 2 to 3 week process for clients once we move them into the system, but it's about a 5 to 7 week turnaround for us, except for this group. We've got a little, we've kind of dedicated an organization, and I'll kind of share that with you as we wrap up to help with this team. Once you sign the engagement letter, it'll take you to the deposit page for the $2,600. Again, it's risk-free. If we don't feel like you qualify, if you don't end up getting a check, we'll end up refunding that $2,600. Most of our clients just pay with a credit card. You can get your miles or rewards, cash back, whatever. But if you wanted to mail a check, we have a P.O. box. It's the easiest. If you send to our corporate, they'll just mail it to the P.O. box, which is fine. And then you could do ACH or wire. We try and make it however it's convenient for you guys, and I think mostly credit cards are pretty convenient. So it'll take you to the payment page, and you can use a credit card. That's great. Then we'll send you out all the information. You can provide the questionnaire, the revenue spreadsheet, the 941s, payroll documents. We'll basically need each wage for employee by the quarter. We'll need to know if you're either the names of the employees or if you got an employee ID number, because the IRS makes us basically break it out per employee is how this has to be calculated. We'll get your PPP loan details. And once you come into our system, there's an onboarding specialist that will be assigned to your file. So you'll have a point of contact at Jorns & Associates at all times. If you have questions, if you need something, your onboarding specialist will be there to help you through this process. We also have CPAs that'll prepare each of your filing documents. We have several teams of CPAs. We have review CPAs. We have doc prep CPAs. We actually have CPAs that are dedicated to the aggregation team. That's the ones that, if you come in and you tell us, hey, I've got 6 companies, they're going to say, let's get an org chart, let's get your tax returns, and let's find out, should they be aggregated? It can be a positive. There's definitely pros to be aggregated. There's negatives to be aggregated. We've had clients that had 15 locations in California, and 22 locations in Florida, and they were aggregated, and the California restrictions hold the Florida locations to those restrictions, which sounds kind of crazy, but we don't make the rules, we got to play by them. And the IRS says if you're aggregated, if there's a mayor that went a little aggressive and shut down certain parts of your operation, all of your operation was shut down for that part. The other thing that's in our favor when qualification comes up is every order, state, local, or federal, there's over 12,000 of them. We've logged every single one of them. You tell us your zip code, your city, your state. We'll tell you what orders could have affected you. But if there's an order on the books, state, local, or federal, that is lawful, which means it could be a governor, it could be a mayor, it could be a county commissioner, it could be a county health department, it could be a judge. If it's on the books and it was lawful, it is deemed to be fully enforced. Even if you ignored it, even if you didn't know it existed, if there was an effect and we can point to that order, it's definitely possible you're going to be able to qualify. And we can work with you on that, like I said, with our qualifications team. Once we get all of our documents, we'll have your team review everything, the qualifications report, the calculations. You'll know to the penny what you're getting. When we go to file, like I said, we don't guarantee any number until we run your payroll. Once we run your payroll and go through the qualifications piece, we will know literally to the penny. Like Tommy, he knows it's I don't know what it was, 7-some million, but I mean, I could probably make a quick text to one of our CPAs and go, hey, tell me what Tommy qualified for, and they'll send it literally to the cent of exactly what we've applied for. You'll actually get more than what we apply for, because this is, when you get a letter basically letting you know, hey, the money's coming, which it takes time, and you know, it kind of says here, 24 to 36 weeks is about the time frame. But the bottom line is, it's termed an overpayment, so you get interest on the money. It's not a ton, but interest has been around 3.22 for the IRS, so they've been paying about 3.22%. So if they were basically, if you overpaid $1 million and it was half the year that you were waiting on it, and you know, basically they're going to calculate interest for half a year. They'll say, all right, you know, we're going to give, you know, 1.5 on top of the $1 million. So it's $1,015,000 is what you get for that, which is great. So they'll give you interest on that. And again, when you get the checks, we'll reimburse you for the remaining balance. We credit that deposit to you on the back end. You can obviously do some of your own due diligence. There's a lot of information out there. The IRS.gov site is the best place to go get information because it's accurate. Even though it'll tell you, hey, this page isn't current, the PDFs you see there, if you click on like Notice 2120, Notice 2149, Notice 2123, those are accurate. Those are up to date. So you can look at the guidance. Now, I'm not telling you have to read hundreds of pages of guidance, but if you have questions, if you say, why do we qualify, or your CPA says, I don't understand why we qualify, our team will sit down with them, no problem, and we'll send them the guidance, we'll quote it out, and then we'll send them your report and say, here's why they fall into the guidance. It's black and white for us. Bottom line. RSM, when we worked with one of their clients recently, they had them qualified for $300,000. There were several quarters they did not qualify them for. I asked them why. We were on a Zoom meeting with my qualifications and compliance team, some of my tax attorneys, and their CPAs were on. They didn't have their tax attorneys on from RSM. And one of the CPAs' name was Tim, and he goes, well, here's why we didn't qualify him. And he came up and he told me why. And I said, and I'm not someone in a, you know, like a Zoom in front of a bunch of people to kind of call someone out, but we had this client qualified for $1.7 million. They had him qualified for $300,000. So this is a $1.4 million swing on ERC. So I probably didn't have the best bedside manner, but I said, Tim, you're wrong. And I said, where's the guidance? I said, show me the guidance that you're referring to, why they would have to check this box off. Because we have 3 boxes they needed to check off. They checked them all off, and you're telling me there's a 4th box. Show me where it says that. And he was fumbling around. I said, listen, I'm not going to waste anybody's time. I'm not going to argue with you. I said, why don't you do this? Take our assessment, take our qualifications report, send it to your tax attorneys, because RSM, I mean, it's a $2.7 billion accounting firm. I said, I knew their tax attorneys are out of their DC office. I said, send it to DC, have your tax attorneys look at our assessment and our report, have them look at your assessment and your report, and have them get back to us. Within 24 hours, they came back to us, and their tax attorney said, Jorn's assessment is correct. It's the one to go with. And we moved forward on a $1.7 million filing for that client. And the bottom line is that's a massive, massive swing. And we've seen errors out of a lot of accounting firms because even as big as RSM is, That accountant that was working that file, that's what he is. He's a regular accountant. He was doing some of their payroll. He was doing some of their audits if they needed audits done. He was doing tax filing returns for them. Oh, and by the way, it's like I look at it, it's like, yeah, the guy's selling hot dogs, lemonade, and we do ERC on the side. It's like, that's not the way to do this program. That is not the proper way to do this program. And this guy doing it that way was going to cost his client $1.4 million in money that his client deserved. And I'm not the one that said that. RSM's own tax attorney said that. Hey, we agree that they do deserve this money. And so the bottom line is doing this the right way is extremely important. There's plenty of information out there, but the IRS guidance will talk about it.